Okay, so we are back, and we are on slide 14 of handout number 11. And we're now going to turn our attention to section 85.1. And section 85.1 is, as we're going to see, by far the most complex of the share-for-share exchange provisions. And it's also the it has the distinction versus section 51 and section 86 of being an exchange of shares of one corporation for another, and because of that, it's as close to a cash out as we're going to allow on a totally tax deferred share for share exchange. And it's worth it, even though you can get the same result under subsection 85.1, because there's no filings under subsection 85.1. You may have to report something in a return, which would just be a disposition at cost, but you don't have to file anything. And so on a large public transaction, this could save the filing of hundreds of thousands of T2057s, and I know the big four accounting firms are charging like $2,000 a pop for that. So it's a material cost savings if you have a share for share exchange that could qualify for section 85.1 to make sure that you actually do qualify. That being said, it is lots of conditions of application, so many that they had to spread the conditions of application over 2 subsections in order to get them all. So we're going to go through them right now, and we're going to see how section 85.1 works when all of those conditions are satisfied. So first, we can look at subsection 85.1 sub 1 itself. And so here the conditions are relatively basic. The purchase of the shares must be a Canadian corporation. Okay, like that's relatively easy to meet, just basically a corporation incorporated in Canada. Well, okay, done. Second, the consideration for the shares sold must be shares of a Canadian corporation. Again, that's fine. So we know that the Canadian corporation that's acquiring the shares has to issue its own shares to the seller. That's easy enough. Next, the shares that are being sold must be capital property of the vendor, which again, if they're private corporation shares, would almost certainly be the case. And if they're public corporation shares, for most individuals are probably not a concern unless they're a trader or dealer in securities. And the corporations whose shares are being sold must be a taxable Canadian corporation. So again, that's relatively easy, just a corporation incorporated in Canada that's not exempt from Part 1 tax. So okay, that's most corporations. And then finally, the vendor cannot report any portion of the capital gain or capital loss that would otherwise be realized on the disposition of the shares. And so what this means is that the vendor either has to choose between a complete deferral under subsection 85.1 sub 1, or they have to have a taxable transaction unless they want to elect under subsection 85.1. So those are the basic conditions. And we flip to slide 15. We have the more complicated conditions to comply with. So first, the vendor and the purchaser have to deal at arm's length prior to the share exchange. For these purposes, any rights under paragraph 251(5)(b) to buy the shares are ignored. But otherwise, you do get into this, first of all, it's easy enough to determine if the purchaser and vendor are related to one another, but you do have this more nebulous arm's length test that you would have to worry about just factually in some instances. If it's a public company transaction, obviously any individual shareholder of the vendor is almost certainly going to deal at arm's length with the public corporation. In a private corporation context where you have a smaller deal, you might worry about this a little bit more if there's some kind of non-related relationship between the parties prior to the consummation of the deal. That's condition number one. Second, after the exchange, the vendor, persons not at arm's length with the vendor, or a combination of the vendor and non-arm's length persons, cannot control the purchaser and cannot have shares representing more than 50% of the issued and outstanding shares of the purchaser. So basically what this means is that you can't have a reverse takeover under section 85.1. If you're going to do a reverse takeover type transaction, it's got to be done under subsection 85 sub 1. Or you could have a reverse takeover, but as long as all the shareholders of the vendor of the target corporation are dealing with one another at arm's length, then potentially that could work. But yeah, like that would be generally where you'd have to make that happen. Third, the vendor and the purchaser cannot elect under subsection 85.1 or 2. So that one's actually more basic. That's the pretty black line condition, right? You know that that's either happened or it hasn't. And then finally, the vendor cannot receive any consideration for the exchanged shares other than shares of the purchaser. However, there is a carve-out in paragraph 85.12d, and this permits what we call a dirty 85.1, where every vendor would sell 2 tranches of shares. They would sell 1 tranche of shares exclusively in exchange for shares, and 1 tranche of shares exclusively in exchange for cash. This complies with section 85.1 because no consideration other than shares of the purchaser is being assigned to the share for share tranche, and the cash consideration is being assigned exclusively to the shares for cash tranche. So if you're going to do this in practice, you do need to be very, very careful with your documentation in order to ensure that you have actually created separate tranches and that you have firewalled the tranches from one another. So then if we flip to slide 16, we can see the effects of subsection 85.1 sub 1 applying. The actual effects are mercifully straightforward relative to the complexity of the conditions of application. Paragraph 85.11a deems the vendor to have disposed of the old shares for proceeds of disposition equal to the ACB of the old shares, and to have acquired the new shares at a cost equal to the ACB of the old shares. So the result is a totally tax-deferred transaction for the vendor with no possibility of gain or loss recognition, at least to the extent of your share for share tranche. If you did a dirty 85.1, there might be some recognition in the, as a result of the transaction in a more holistic sense, but the particular transaction to which section 85.1 applies can never have gain or loss realized. Paragraph 85.11b deems the purchaser to have acquired the target shares at a cost equal to the lesser of the PUC or the fair market value of the target shares immediately prior to the exchange. So this can create actually some interesting results where the fair market value is less than the PUC of the shares, which it sounds weird, but that has happened in the past. And you might get some anomalous results. But generally speaking, it's the cost is going to be, generally speaking, the PUC of the shares. So then if we flip to slide 17, we have the last piece of subsection 85.1 sub 1, which is subsection 85.1 2.1. And subsection 85.1 2.1 is a puck grind that applies on a class by class basis. Like subsection 51.3, if the puck of all of the classes of shares exceeds the puck of the old shares, then the excess becomes a grind that's allocated across all the classes of consideration shares based on their proportionate share of the total puck increase. If only one class of shares is issued as consideration, then the effect of subsection 85.1 2.1 is that the puck of the new shares is going to be ground to the puck of the old shares. So again, relatively straightforward, at least compared to the conditions of application. So with that, we can flip to problem 3. And in problem 3, we have an individual X who owns 500 Class A shares of Y Co, which have an ACB of 1,000, puck of 500, a fair market value of $10,000. X transfers the shares to Z Co in exchange for 100 Class Z shares of Z Co, which have stated capital of $10,000 and a fair market value of $10,000. What are the tax consequences of the exchange to X and Z Co, ignoring section 85.1? So in this circumstance, because this is the section 85.1 problem, let's assume for the moment that our individual X deals at arm's length with Zco. And so as a result, we don't have to worry about section 84.1 applying in the situation where potentially subsection 85.1 could apply. So let's assume that that's not the case, and we'll just deal with this more straightforwardly. If there was no section 85.1, then the sale of the shares for consideration consisting of shares of a different corporation would, in the absence of a subsection 85.1 election, be a taxable transaction. On the taxable transaction, our individual X would have realized a capital gain of $9,000, being the difference between the fair market value of the old shares of $10,000 and the ACV of the new shares of $1,000. There wouldn't be a puck reduction in this case as long as X and Zco deal at arm's length, and no deemed dividend would arise under subsection 84.1, since the puck addition in this case actually reflects an increase in Zco's net assets as a result of the transaction. But because we're going to have cash on a $9,000 capital gain and a $4,500 taxable capital gain, our individual X is just going to have to come up with the money to pay tax on that capital gain, which is probably not ideal in a share-for-share exchange situation. Unlike our last examples, this is somewhat of a less preposterous hypothetical, right, than in other situations. It's easy enough to break the conditions of section 85.1 that you could actually have a share-for-share exchange that, in the absence of section 85 sub 1, would be a taxable transaction. But the problem then goes on to ask, okay, well, that being the case, what is the effect of subsection 85.1 sub 1? So again, we're going to make some assumptions here in order to satisfy ourselves that section 85.1 can apply. Specifically, we're going to assume that YCO is a taxable Canadian corporation, that ZCO is a Canadian corporation. We're going to assume that the Class A shares of YCO rather, are capital property of individual X, And we're going to assume that individual X is not going to report any gain or loss in relation to this disposition. We also need to assume that X and Z co deal at arm's length prior to the exchange, and that Z co shares are valuable enough that our individual X is not going to control Z co either alone or together with non-arm's length persons after the exchange is complete. We then need to assume that no election is going to be made under subsection 85.1, and it would be weird if we were asking a question about subsection 85.1 sub 1 and then included a subsection 85.1 election, so that's probably a safe assumption in the context. What is clear, where we don't have to make an assumption, is that there's no non-share consideration received. The problem is quite clear that the only consideration received is share consideration, and that the shares are shares of ZCO. So at least we know that part of the conditions of application of section 85.1 are satisfied. So with those assumptions out of the way, then we know that paragraph 85.1(1)(a) will deem X to have disposed of the YCO shares for proceeds and disposition of $1,000, being the ACB of the YCO shares, and to have acquired the new ZCO shares at a cost of $1,000. Then ZCO is deemed by paragraph 85.1(1)(b) to have acquired the YCO shares at a cost equal to the lower of PUC or fair market value, the PUC being $500 and the fair market value being $1,000, the PUC being the lower of the two. And so therefore, the ACB of the YCO shares to ZCO is going to be $500. Finally, we turn to subsection 85.1(2.1), which we have to consider in this case because it looks like Z added the maximum amount permitted under the BCA to the stated capital of the consideration shares, the Class Z shares issued to individual X. Since the PUC of the new shares of $10,000 exceeds the PUC of the old shares of $500, then we know that there's a $9,500 PUC grind required. And since we only have one class of consideration shares, then the PUC grind is entirely allocable to the Class Z shares. And so the PUC gets reduced from the corporate law stated capital amount of $10,000 to $500. All right, so does anybody have any questions about how that works in the base case problem? Okay. Seeing none, let's do some permutations on these problems and other just related problems. So part A of problem 3 asks, can X choose to realize all or part of the accrued gain on the Class A shares? And the answer is no. X cannot, the way the problem has been structured, because if X did try to realize any part of the gain, X would now no longer satisfy the conditions of subsection 85.1 sub 1 because X has reported any part of the gain or loss that would otherwise be realized, and therefore section 85.1 just simply does not apply to X. It can apply to the other shareholders, to be clear, if there's other shareholders of YCO who are selling shares to ZCO, but it no longer applies to X. So if X wanted to realize part of the gain or loss, X would effectively have two options here. X could structure this in tranches and then have a tranche where X does the straight 85.1 transaction, and then a second tranche where X reports gain or loss, and that would be fine. Or X could just abandon the idea of relying on section 85.1 at all and can rely on subsection 85 sub 1 and jointly elect with ZCO to realize part of the gain. This is a solution that works in a situation where there's a relatively small transaction. It does not work in a large public transaction. If you're random individual X and you are dealing with a takeover of a TSX listed corporation, and it's supposed to be a section 85.1 transaction, and you go to the buyer and you say, hey, I see this is supposed to be 85.1 transaction. There's no provision in the share purchase agreement and whatever else is on CDAR that would allow me to elect under subsection 85.1. Can I elect under subsection 85.1? They're probably going to say no, right? They will almost certainly say no if it's just individual you, and there's no provision for these elections on the publicly filed documents. So that may be a problem, right? So in most circumstances where you don't control the terms of the deal, section 85.1 is going to apply like a take it or leave it type provision. Then part 2 of the problem, part B, the question asks, well, what happens if X receives cash of $1,000 and Class Z shares of ZCO with a fair market value of $9,000 and PUC of $9,000? So the answer here, like we talked about, really depends on how the agreement between our individual X and ZCO is worded. If there is only a single agreement, and the single agreement provides for a sale of all of X's shares for $1,000 of cash plus $9,000 of shares, then the conditions of subsection 85.1 sub 2 are not satisfied, and subsection 85.11 will not apply, and you will just have a taxable disposition scenario, and unless you elect under subsection 85.1. However, if the agreement was structured so that X is selling 50 YCO shares for $1,000 cash, and then after that transaction closes is selling 450 YCO shares for $9,000 of shares, then paragraph 85.12d would permit subsection 85.1 sub 1 to apply to the second tranche of shares that's being sold in exchange for $9,000 of shares. So that's again pointing out the importance of tranches if you're going to have some mixed consideration. The other very smart-ass answer to this question would be that the CRA does have an admin position where they will permit some token cash consideration on a section 85.1 transaction in very limited circumstances. For example, where there's a need to pay cash to a vendor in order to avoid the issuance of fractional shares, and the total cash does not exceed $200 per transferor. So basically what this would mean is that your buyer's shares would need to have a per share value of under $200, or else you're probably going to have a problem where the cash out on the fractional share is going to exceed $200 per vendor for some vendor. So that's the solution. However, probably better if you can to just go all share or do it in tranches so that you don't have to worry about that $200 cap. So that is section 85.1. Does anybody have any questions about section 85.1? I would point out while you're thinking of questions that there are some diagrams at the end of handout number 20 that just show how these provisions are supposed to work. So if you want to think about them diagrammatically, that might help as well. Okay, seeing no questions, we can call it a day. I will stop recording.